Hello everyone, my name is Rifki from Group 10 and I'll be starting off our presentation on stock investment by covering the fundamentals, what stock investing actually is and how it is works here in Malaysia. Before we get into the mechanics, let's talk about why matters. When most Malaysian households think about saving, they think about EPF or fixed deposits, and those are great for safety, but they only offer modest returns. Stock investment work differently. Instead of just saving money, you're buying ownership in real companies, which give you a chance at much higher growth over time. So, of course, that comes with more risk and ups and downs along the way. And here's the key point for a lot of Malaysian households, relying on EPF alone may not be enough to hit long term goals like retirement, especially once you factor in inflation slowly eating away at the value of your savings. So, what exactly is a stock? Simply put, a stock is a unit of ownership in a company. When you buy a share, you're not lending the company money like you would with a bond. You're actually becoming a part owner. And as an owner, you benefit in two main ways. First, through dividends, which is a portion of the company's profit paid out to shareholders. And second, through capital appreciation, which is when the value of your shares increase because the company grows. Companies issues these shares in the first place because they need to raise capital for expansion, for operation, or for new projects. Now, how does buying and selling actually happen? It's a simple three-step flow. A company issues shares to raise capital. Those shares get traded on an exchange where the price moves based on supply and demand, and the investors, people like us, buy and sell those shares usually through a broker. Here in Malaysia, that exchange is Bursa Malaysia, formerly known as the Kuala Lumpur Stock Exchange. To actually start investing, you'll first need to open a CDS account that stands for Central Depository System, which is basically your official record of share ownership. After that, you fund a trading account through a licensed broker or platform, and you're ready to start buying and selling. With that foundation in place, here's what the rest of the team will be covering. Next, we'll look at Malaysian household investment practices, followed by some study case analysis. After that, we'll dive into risk, return, and investment strategies, then connect stock investing to long term financial goals, and finally wrap up with common challenges and our recommendation. And I will and now I'll pass it over to the next member to continue the explanation.
The main objective of this topic is Malaysian household investment practice. For the first part is overview of asset creation. Traditionally, we have a highly conservative investment profile because we rely heavily on capital guaranteed instrument and government support. There are five main categories of asset creation. First one is EPF, which is Employees Provident Fund. This is the backbone of our retirement. It is the largest asset for private sector workers, providing stable inflation-beating returns of around 5% to 6.5%. Second, SB and SMD for the Bumiputra demographic. SB is the top choice due to its fixed price of RM1 per unit, meaning zero market volatility risk. Third one, fixed deposit, a safe haven for other demographics to secure short-term liquidity, even as the overnight policy rate precious. Next, insurance and takaful, especially hybrid policies like investment-linked policies that combine medical protection with conservative investment fund. The last one is direct equities, previously viewed as a playground for the wealthy or speculative traders. However, we will soon see how the segment has completely transformed. Next part is impact of low-cost platforms. In the past, opening a central depository system (CDS) account was a massive hassle, requiring piles of paperwork, and brokerage fees were expensive, sometimes reaching RM28 per transaction. Today, over 80% of all new accounts are opened via digital platforms. The first one is Momo and Rakuten Trade. They introduced ultra-low fractional fees, sometimes just RM1 to RM3, and made micro-investing highly affordable. Second, Bursa Anywhere, the official Bursa app that allows for CDS registration, corporate exercise tracking, and e-IPO application directly from a smartphone. The last one, Robo-Advisors and KDI. These platforms made it easy for passive investors to automatically invest in global ETF using smart algorithm, entirely removing the edge of picking individual stocks. For the last part is cultural and behavior dynamics. Finally, we must understand the psychology of the Malaysian investors. We are culturally conditioned to expect the safe, guaranteed returns of SB and EPF. For many households, seeing an asset drop 10% in a week feels exactly like gambling. We call this the capital preservation mindset. However, this behavioral inertia is slowly shifting due to three main catalysts. The first one is the inflation gap. People realize that money sitting in FD is no longer enough to combat the rising cost of living or protect their long-term purchasing power. The Shopeeification of wealth, which is the process of buying shares, is now as easy and frictionless as ordering food or shopping online. The psychological barrier to entry is completely gone. The last one, a world-class Sharia ecosystem. This is perhaps the most crucial factor. Around 80% of companies listed on Bursa are Sharia compliant. With the assistance of certified Islamic digital brokerage and robo-advisors, the conservative Muslim majority can now confidently participate in equity markets without compromising their ethical or religious values.
Today, I'd like to share a few real-life case studies that highlight the true impact of financial planning. Let's start with my case, which is cost of delaying investment. Take the story of Uncle Rahim. He worked a steady middle income job for over 30 years and was a very conservative saver. He kept his surplus cash in standard saving accounts and relied entirely on his EPF for retirement, avoiding the stock market or mutual funds because he felt they were too risky. However, at 55, he realized that inflation and severely eroded the purchasing power of his money. Meanwhile, his younger sister, who actually earned a lower salary, started investing just RM200 a month into an equity fund in her 20s. Thanks to the power of compound interest, she built a retirement nest egg that far surpassed his savings. So the key takeaway is time is your greatest asset. You simply cannot make up for lost time by just saving more later in life. Okay, the next slide. The 2020 to 2021 Bursa retail boom. Moving on, let's look at a major event right here at home. The Bursa Malaysia retail boom during the pandemic lockdowns. During the MCO, people were stuck at home. Many had extra cash from loan and 1,000 open CDS accounts. Retail investors flooded the market, heavily driven by the hype surrounding glove and healthcare stocks. Unfortunately, many inexperienced investors treated the stock market like a casino to make quick cash rather than a platform for long-term wealth building. When the pandemic stabilized and vaccine rolled out, those stock price crashed back to normal levels. The latecomers who bought at peak price suffer massive paper loss. The lesson here, investing based on emotional hype and herd mentality leads to wealth destruction. Consistent, boring, and educated investing will always be chasing short-term trends. Okay. Let's look at the opportunity cost of EPF withdrawals through schemes like ICNR and iLestari. While these schemes were meant as a lifeline for those who lost their jobs, reports show that many people withdrew their retirement funds for short-term ones, like upgrading smartphones, buying cars, or joining gold schemes. The long-term impact of this is massive. When you take out RM 10,000 today, you are just losing that RM 10,000. You are losing decades of guaranteed compounding dividends. Compare this to those who tighten their budget, kept their EPF untouched, or even invested their surplus cash during the market crash. The gap in their retirement readiness is now drastically different. The final takeaway, which is key lesson here, protect your long-term goals from short-term desires. Without a proper emergency fund, people are forced to sacrifice their retirement security just to solve today's challenge. Thank you.
Many people in Malaysia rely mainly on EPF for retirement. While EPF provides a stable foundation, it may not always be enough to maintain our desired lifestyles after retirement, especially with rising living costs and longer life expectancy. Stock investing can help supplement EPF because it generally offers a higher long-term returns. Besides capital appreciation, investors may also receive dividend income. More importantly, investing early allows us to benefit from compound growth, where investment returns continue to generate additional returns over time. As shown in the chart, the stock market has historically provided higher average annual returns than EPF and fixed deposits. Therefore, stocks should be viewed as a complement to EPF rather than a replacement. Next, let's look at the impact of inflation. Inflation reduces the purchasing power of money over time. This means that the same amount of money today will buy fewer goods and services in the future. The chart compares the growth of 10,000 ringgit investments over 13 years under different investment options. A fixed deposit grows to about 24,000 ringgit EPF grows to around 15,000 ringgit, while stock investments can exceed 100,000 ringgit because of higher long-term returns and compound growth. This example shows why starting early is so important. The longer we invest, the more time compound interest has to work in our favor. However, a stock investing should not be viewed as the only financial strategy. A balanced financial plan starts with building an emergency fund to cover unexpected expenses. Next comes insurance protection to reduce financial risks. After that, EPF provides a stable retirement foundation. Finally, stock investments help increase long-term wealth. In other words, stocks are one component of a complete financial plan. Diversification helps reduce risks while improving long-term financial security. Finally, stock investing should always be linked to personal financial goals. Different goals have different investment horizons. For example, buying a house may require a medium-term investment strategy. Saving for children's education requires a longer investment period. Retirement planning usually has the longest investment horizon, allowing investors to take advantages of a long-term stock market growth. To achieve these goals successfully, investors should invest consistently, start early, diversify their investments, and match their investment strategy with their financial objectives. In conclusion, stock investing is not about making quick profits. It is about building wealth steadily over time and helping individuals achieve long-term financial security.
I'll be talking about some common investment mistakes that many Malaysian retail investors make. So, the first mistake is lack of research. So, some people invest based on what they see on social media or from friends without properly understanding the company. So, this can lead to poor investment decisions and losses. And the second mistake is the behavior known as FOMO, fear of missing out. This basically happens when investors buy a stock simply because everybody else is buying it. So they don't want to miss out on the potential profits, but sometimes they end up buying in a very high price. So another common mistake is basically panic selling. When the market goes down, some investors become afraid and quickly sell all of their investments. As a result, they may miss the opportunity to benefit when the market gradually recovers. So, lastly, we have over concentration. So, this means putting too much money into a stock or one sector. If that investment performs poorly, the investor may suffer significant losses. So, therefore, investors should do proper research and stay calm during market fluctuations and diversify their investments to reduce risk. So, now let's take a look at the illegal investment scheme and scams, which are still a major issue in Malaysia. So, looking at the first section, some of the most common scams include Ponzi schemes, pyramid schemes, fake investment programs, and scams promoted through social media or WhatsApp. So, a Ponzi scheme works by using money from new investors to pay earlier investors, creating the illusion that the investment is profitable. And a pyramid scheme, on the other hand, is focuses on recruiting more people into the scheme, and participants earn money mainly from new members joining rather from actual investments. So nowadays, many scammers also use social media platforms to advertise fake advertisements, opportunities, and promise very high returns in a short period of time. So let's move on to the next section, which is why do investors become victims? So, one of the main reasons is a lack of financial knowledge. So, some people may not fully understand how investment works, and it makes it easier for them to believe unrealistic promises. So, another reason is the attraction of high returns. So, when people see offers that claim they can double their money quickly, they may ignore the warning signs. And some investors also fail to verify whether the investment company is actually licensed and regulated. So, now how can we stay safe? So, first, always verify the investment with the Securities Commission Malaysia or SC. Secondly, conduct proper research before investing any money. And finally, be cautious of any investment that guarantees profits with little to no risk. So, because legitimate investments always involve some level of risk. So, overall, improving financial literacy and being more careful when evaluating investments opportunity can help investors avoid scams and make better financial decisions. So now let's move on to some recommendation for Malaysian investors. So looking at the first point, it is important to continuously improve financial knowledge. So before investing, people should understand that their basic concepts of investing such as risk, diversification, and long-term planning. So investors can learn through trusted platforms such as InvestSmart, Ringgit Plus, and AKPK, which provide useful financial education and guidance. So, next, investors should consider starting with diversified investments instead of putting all their money into one single stock. They can spread their investments across different companies and sectors. So, one of the example is ETFs or exchange traded funds, which allows investors to gain exposure to many companies through a single investment. And this helps reduce overall investment risk. And finally, investors should always use regulated platforms. This means investing through licensed brokerage firms and verifying investment companies before investing any money. And using regulated platforms, it provides greater security and help investors avoid scams and fraudulent investment schemes. And in addition, investors should focus on long term financial goals instead of reacting to short term market fluctuations. So, staying patient and disciplined is often more effective than trying to make quick profits. Overall, successful investing requires financial knowledge, diversification, and investing through trusted and regulated platforms. All right, so to conclude our presentation, stock investing is an important tool for long term wealth creation and financial security. So, compared to traditional saving instruments, stocks generally offer greater growth potential and can also help investors protect their purchasing power against inflation over time. So, however, successful investing is not simply about just buying stocks. Investors need to understand the relationship between the risk and return, practice diversification, and adopt disciplined investment strategies to manage risk effectively. And at the same time, as well, investors should avoid common mistakes such as emotional investing, investing without proper research, poor diversification, and falling victim to investment scams. So, therefore, continuous financial education and the use of regulated investment platforms are essential in helping investors make informed and responsible investment decisions. So, it is also important to remember that the stock investments should complement other financial planning tools such as EPF savings, insurance protection, and emergency funds rather than replacing them. So ultimately, by maintaining a long term investment mindset and making informed decisions, Malaysians can work towards achieving their financial goals and building sustainable wealth for the future. So, thank you so much.